I just want to get your views, Jeffrey, on what's transpired in the markets in the last few months and as it relates to the economy as well, and the Fed dependency here. How do you think about the Fed's role in the overall economy and the markets?
Well, the Fed has decided that they want to pull out all the stops to reduce market and economic volatility. I think that was what really got them going in the later part of March and early part of April, was that markets, not just the stock market, but commodity markets, junk bond markets, interest rate markets, were experiencing really persistent and elevated volatility. And they just kept throwing things at it to make the volatility stop. And of course, when investors use the word volatility, what they really mean is down, prices going down a lot. And the Fed came in because there was a total seize up in really the credit market system around the world, but of course, relative to the Fed in the United States. I've been in the market for 35 years, and I've seen all kinds of crises, including I was right at the front lines during 2008, 2009, during the global financial crisis, which really hit the securitized asset sector. And what we experienced in the last part of March was far worse in terms of market conditions in the investment grade corporate bond market, in the emerging markets, certainly in the junk bond markets, far worse than the very worst day in March of 2009. Literally in 2009, you could get a bid. You didn't like it. The prices were in a free fall from the day before on the really ugly days of maybe 10 or 15% price moves to the downside in a single day. But in March of 2020 here, there was no bid. There were actually situations in large swaths of the fixed income market where you simply could not sell assets. And that led to what looked like was going to be some very substantial bankruptcies in some of the leveraged pools like mortgage-related REITs and other leverage types of investments. And the Fed just figured that at desperate times, they required desperate measures, and they went all the way into buying corporate bonds, which, as I've said in my webcasts, is not allowed under the Federal Reserve Act of 1913. And they did not buy corporate bonds during the global financial crisis, even though I know for a fact they talked a lot about it, because I know people that were inside the Fed at those discussions. But what they're doing is really a bridge further than they've ever gone before, where they're not even following their own charter, which means that the Fed could go even further in violation of the Federal Reserve Act of 1913 if they really feel like, we go into another economic move down. So the Fed has propped up the economy with just the most incredible fiscal lending that they've ever contemplated. And of course, I think the listeners know that the quantitative easing that the Fed has done since March is greater than all of the quantitative easing that they started back, in the global financial crisis. It was more in just 3 or 4 weeks than that entire program that was laid out over a multi-year framework. So that shows the level and extent of their commitment.
Yeah, certainly the word that gets tossed around is unprecedented. And you were just referencing your 35 plus years in the market's never seen anything quite like this. We've talked a bit in the past, Jeffrey, about corporate credit and, the issues that were already there to begin with. How do you begin to assess those issues with the latest Fed moves? And are we just delaying the inevitable here?
Well, in a certain sense, I think we're delaying the inevitable because under my analysis, many bond prices that have been pushed up by the Fed's buying of ETFs and then individual corporate bonds more recently, the prices they've pushed many of these assets up to, I think, is a higher price that they're actually paying for them than you'll receive through a bankruptcy workout when a lot of these companies have to go through a filing. Also, as I talked about in the past, we probably talked about this in our last interview, the fraction of the corporate bond market that's investment grade and is the lowest tier of investment grade, which is BBB, is really enormous. It's basically half, or now even more than half of the entire, it's like a $12 trillion market now. There's been so much issuance of corporate bonds, and the prices have been propped up to levels where I think the owners that own them at these levels will end up losing principal on a basket of these assets. So to that extent, they're delaying the inevitable. In the meantime, they have a lot of wherewithal to continue delaying because they are spraying money all over the place and buying all these assets. The one thing that's happened that a lot of investors aren't aware of relative to their corporate bond activities is at first it really popped the prices of UD, which is the investment grade ETF, and JNK, which is the junk bond ETF that I followed. And since then, the price of HYG is not really even up since April 9th, when they really went full in. I think they announced corporate bond purchases as a strategy around March 23rd, but they really upped the ante in a meaningful, very meaningful way on April 9th. And since then, those prices haven't really gone up. They fluctuated, but they're pretty much unchanged. Meanwhile, that has led investors that understand that the price of corporate bonds today isn't really real. There's no price discovery mechanism that's being pegged. There's no message. There's just a target price that the Fed has been doing, and that led to a pop up in corporate bonds. But since April 9th, which is now we're moving on to about 3 months, the sectors that were left behind to fight for themselves, like the lower tiers, commercial mortgage-backed securities or asset-backed securities, and some emerging market bonds, they've really outperformed corporate bonds because they're catching up as investors realize that the interest rate profile of investment grade, like the LQD, is very long. I mean, it's about an 8-year duration. So it's about the interest rate risk of almost a 10-year treasury. And yet the yield to no losses is about 2.25. So there's not a lot of reward there. And there's a lot of risk if those bonds get downgraded, because the yields on junk bonds are far higher today than the yields on BBB corporate. So if they get downgraded, we know that the pricing is going to suffer very significantly. So in that way, the rating agencies might have an influence that the Fed can't really offset that easily, because those downgrades lead to probably about a 200 basis point spread widening, which means about a 15-point price drop if the market starts to factor in the potential for the credit quality to be reevaluated to the downside.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.